Okay, so I'm going to move on now. This is still sticking, believe it or not, with the central banker theme, because this is the announcement of the 25th annual Hyman Minsky conference put on by the Levy Economics Institute at Bard College this year, which I'm fortunate enough to attend. I don't know why they let me attend, but they do, you know. And I go there every year, and I try to ask relevant questions, pertinent questions about whatever it is that they're talking about, to try to get my. And by the way, I have great conversations there. Honestly, I have great conversations there. You know, sit down at lunch with central bankers or people from the Fed or Treasury or whomever, and I find the people are always engaging when they're at lunch. So even at the refreshment break. So this was this year's conference, and I want just putting it up there because I'm going to mention some dialogue that happened over there, and I want everybody to be able to go there and see it because it's all available there. Okay, so that's their announcement of it, and there's a number of panels. And this was the panel that I was most interested in. Minsky, Inequality and Monetary Fiscal Policy Outlook. Boy, covers a lot of stuff. You got inequality, you got monetary policy outlook. So the speakers are, you know, on the left is Dr. Scott Fulwiler, and in the middle Dr. Stephanie Kelton, and on the right is Dr. Jan Kregel, 3 doctors. Who are all, by the way, nice people and bright people. Very nice people and very bright people, okay? But I swear they do not get money. And Dr. Kelton is the chair of the economics department at the University of Missouri, Kansas City, which is the hub of modern monetary theory activity. So the main thing about Dr. Kelton and why she kind of rose to huge fame, and she's a post-Keynesian, basically, and then a modern monetary theory person on top. And I have no problem with post-Keynesianism, just so you know. I'm totally post-Keynesian type of person. And Dr. Scott Fulwiler just moved into the University of Missouri, Kansas City Economics Department just with this semester. With this semester. And he took Dr. Randy Ray's place because Dr. Randy Ray moved over to Bard College, which is where Levy Economics Institute is housed. And so anyway, they gave this talk, and I want to try to, if I can, to parlay a part of Dr. Kelton's presentation, because she was there speaking as the former chief economist to the Senate Finance Committee. And she had been hired by Bernie Sanders, one of my favorites in the world, and even still. And Bernie brought her in because she's a post-Keynesian. She can talk about the fact of why we need to do deficit spending when the private investment is not making the economy achieve its potential. And she's really great at that, and she does that really well. So she presented on her experience at Senate Finance. And what was her experience? Well, basically, she said we can't do anything. And there's one reason why. Public debt. She said, both sides of the aisle abhor any discussion of an increase in the public debt to achieve any social good, to achieve any benefit especially to the public. So they say, if you're going to do anything, what you really have to do is, you know, the PAYGO. I don't know if you guys are familiar with PAYGO. It's a budgeting thing. You know, if you're going to add something to the budget, you got to take something out of the budget because you ain't going to increase the debt. Okay. So her talk there was about, because of this fear of public debt, both sides of the aisle not willing to do anything, not able to do anything, and nothing is going to change. She said that, you know. But she also brought out the fact that, I don't know if I'm going to be able to do this. She also brought out the fact that as part of her presentation, she works with the construct of functional finance, and I don't know, functional finance is actually a big part of the post-Keynesian school. Functional finance, something brought about by Dr. Abel Lerner, who was actually a very good economist and knew a lot of stuff. And what it basically says, I'm going to try to say it, and it basically says, is that the surplus in one sector of the economy, being the private sector, is equal to a deficit in the other sector. And it sort of stands to reason in the sense that if you take the construct of what it's supposed to be doing, is to say that you have this much economy, this much of it is private, this much of it is public, this much of it is maybe current accounts with foreign trade. But anyway, those are the three components, and those things all go counterbalance each other. And if you understand that, then you can see that the economy can only grow by virtue of having one of those sectors take care of the growth. And that's why it's okay to borrow. Okay, it's okay to borrow. Borrowing is okay. Borrowing is not only okay, it is good, because the route to prosperity is through borrowing. Okay, and I will take issue with Mark Pesch on this issue of public debt. But anyway, so she said, and Lerner said, she said, Lerner was a big, a big proponent of, what we would call public benefit, government, government working for the people. So they finished their talk. Dr. Fulwiler is actually a real specialist, a really knowledgeable guy on the interactions between the Fed and Treasury. That's his specialty, the interactions between Fed and Treasury. And that's why I think that, as soon as she had the opening from Randy moving, she got Dr. Fulwiler on there. So there's come a period of time at the end of their talk, and they open it up for questions, and I raise my hand, because I want to engage at the line of scrimmage, and I will tell you that sometimes they don't give me the mic. Honest, they don't. But it's not a conspiracy. I think it's just luck, maybe. But here I am sitting there. That's me. That's the back of my head right there. That's why I took that screenshot. I had already raised my hand. Jan Kriegel was looking at me like Joe Bon Giovanni again. But fortunately, there was a person that had the mic. She saw me raise my hand. Kriegel didn't call on me, but she brought me the mic. So. All right, I have to change my glasses here because I'm going to try to read something from my screen. I want to tell you about the dialogue, and this is where I'm going to say it. MMT drives me crazy. Okay, MMT drives me crazy. When I really engage people about trying to understand MMT, it drives me crazy. They talk about stuff. I have something else here that I'm not going to be able to get into, which is a dialogue between myself and Warren Mosler, who's the granddaddy of modern monetary theory, the financial person behind all of this stuff. I'm not joking about that, okay? Warren Mosler has a website called Center of the Universe, where Mosler Economics, comes from. And I'm going to just take a minute to give you the background. Back in 2007 and 6 and 7, modern monetary theory was being formed. It was being formed by a discussion that was pretty much managed by Warren Mosler, okay? And Warren Mosler is a banker and fixed income security specialist who made many millions. And he lives down in St. Croix, and he sails his sailboat, and I'm not jealous of him doing that, okay? That's perfectly all right. I got my little sailboat, and I sail it on Chesapeake Bay, and I'm happy. But anyway, Warren Mosler set up all this stuff, but I watched the dialogue evolve, okay? They had an open forum exchange of ideas, and it happened over months and over years. And Warren Mosler, he finessed the discussion with something called functional equivalence, okay? So modern monetary theory is built upon functional equivalence meme. So that's functionally equivalent to that. So it's the same thing, so why talk about it? Why bother? Let's do one or the other. And let's do the debt one. So at the end of her talk, she oops. At the end of her talk, when they handed me the mic, I said, well, I guess, you know, what it comes down to after my sort of paraphrase them is, why aren't we printing the money? You know, one of the things that Abel Lerner said is the government should print the money. Didn't Lerner say that deficit spending should be funded by printing money? Why aren't we talking about that? Why aren't we talking about that option? Yes, it would take a change in the law to do it, and we got that. But it would also satisfy both of those guys, being the Republicans and the Democrats, because we would not have to cut spending, and we would not have to raise taxes, and we would not have to issue public debt. You know, so that was my question, you know. So you got to realize there's a lot of central bankers. There's a lot of chief economists at central banks there. There's regulatory people there. You know, somebody mentioned Ed Kane earlier. Ed Kane and Walker Todd. Now, to me, the price of admission to hear these guys give their talks, tremendous stuff, just tremendous stuff. Fortunately, the price of admission is free if they let you go, which they did, you know, which they have, and I've been going for over 5 or 6 or 7 years. So to my question, Scott Fulwiler responded first, even though I was directing it at Stephanie. He said, I agree, mostly because they're the same thing. That's functional equivalence, you know, in his thing. Printing money and issuing bills is the same thing. Bills, in this case, being more public debt. It's the same thing. And I said to him, oh, that's not really true. If it was the same thing, Bernie would be supporting it. There was some chuckles. There were some chuckles, and there were some nods, and there were some people saying, you know what, that's right, you know? So they didn't want to let me get away with that. So Stephanie Kelton said, well, let me explain. What Lerner actually, this is the narrative. If you go there and you take that, you will listen to it, and this is what you will hear. Stephanie Kelton, Dr. Stephanie Kelton, Chair of Economics, University of Missouri, Kansas City. What Lerner actually explains is that he wasn't proposing the government change the way it finances its deficit. He was explaining the way in which the government already finances deficits. And what Lerner explained was that government deficits are already financed with new money creation. How many central bankers did I tell you was in the room? Because it was 150. Okay? So look, you know, she's educating me, okay? When Congress gets together and want to authorize $1 trillion in infrastructure over the next 5 years, they just count the votes. Who's with me? $1 trillion, she goes. And enough hands go up, and we've authorized the decision. And the checks will go out. We have just decided that we're going to spend $1 trillion. Keep that in mind for a second. The checks will go out, and Scott will explain why this matters, but the spending itself leads to creation of new money. Imagine. Why are we wasting our time here? The spending itself will result in the creation of new money. What are we doing? Taxes will come in, and over the course of the year, tax revenues will come in, and it isn't until the end of the year that the government even knows whether it has run a deficit or not. Senior economists at Senate Finance just made that statement. Okay? So I spend 100, I collect 90, I guess we ran a deficit. And under current law, when I engage in deficit spending, I'm required to borrow. Hello? Hello? That's my point. You know, your point is that government spends money. It creates money when it spends. Now you're saying my point. Which one is it? You know, I think they might have taken the mic back by then. But anyway, so I want to buy treasuries, she says. I spend 100, I tax 90 out, so the rest of the economy has 10, so I'm required to borrow. I say, who wants to buy treasuries? Enough people say, I'll take them. I'll get to 10, I give it to the treasury, and it's done. It's all done. All done ex post. All the complex coordination creates the illusion that what is happening is that the bonds and tax revenues are coming in and are paying for spending. Now this is where I have to say this. I thought maybe I was the only one that heard that. You know? I was like, excuse me? Ed Kane is in the room, you know, Walker Todd's in the room, and people like them, people who know this stuff like the back of their hand, like nobody's business. And I just sat there and went, I did send them an email that night, I will tell you that, and I brought this up, and I said, you guys said this, and you said that, and that ain't true, and what are you doing? You know, why are you carrying on this charade about what's going on here? You know, the law says we have to borrow the money, you know, period. That's what it says. And it says the only thing it can be used for is government spending. So this MMT thing, it does kind of get me a little rankled every once in a while. And it's not because I can't go on Naked Capitalism and comment for 3.5 years. It's because it's a lot of jazz, okay? It's a lot of jazz. It's a lot of jazz, and when I say jazz, I shouldn't say that because I'm a jazz fan myself, so I apologize. I apologize. And by the way, I have the wording here from Functional Finance. Functional Finance is the book that Aberlerner wrote, 1943, okay? And I have the wording here, but I'm not going to read it because I'm pretty much out of time. But this is what's going on out there in the world, folks. This is what is theoretically settling for scholarship. Oh, I really apologize there. I didn't realize that I had that narrative on the slide, and it was on the slide. But to go back to what is going on. We have the study that was done for the Icelandic government, and it's a great thing. You know, it might have limited application, but it's a great thing. Now here I was. Talks about the commercial, but this is from the executive summary. And by the way, the executive summary pretty much says it all as far as I'm concerned. But not that I didn't read the rest of it, I did. But the executive summary says it all. Sovereign money. Really? We're going to get that. Sovereign money system, which is what they decided to call it, okay, aims at shifting money creation from commercial banks to the state and central banks. In this report, we compare the fundamentals of sovereign money system and the current monetary system. The report shows that adoption of the sovereign money system would, well, besides transferring the deposits from being liabilities of the commercial banks, okay, I'm saying besides that, but that's actually what has to happen if the banking system is going to be able to function, because they've got too many liabilities and not enough borrowers, and we're going to face that moment that John talked about when people are paying off more than they're taken out. It also removes the commercial banks from money creation function and separates the payment process from the bank's balance sheet. So in other words, it says it takes those banks out of both the payment system and the money creation. It gives the state the option to put new money into circulation through public finances by paying down government debt or government expenditures, which would raise the disposable income and equity level of households and businesses. And if anybody doesn't realize that that's what the debate is all about right there, that is what the debate is all about right there. Gives the state the option to put new money into circulation through public finance by paying down government debt, if that's what you want to do, or government expenditures which would raise the disposable income and equity levels of households and businesses. That's what we want to do. That's the objective of having a sound, workable monetary system. And the other thing it says, does not need to affect the way the customers and the banks interact with regard to anything they do, and that's a given, but it probably does have to be stated and acknowledged. When you go to the bank, what are you going to do with the bank? You're going to make a deposit. You're just going to go here or there. Okay, it's going to go here or there, and you're going to take out a loan. It's going to look exactly the same. It's not going to look any different. You're going to still have a payment schedule. It's going to still include principal and interest, and so to me, this is the next step, okay, in terms of the next thing, because the great people that work at KPMG in Iceland were able, under their auspices of their gigantic international finance, accounting, auditing, corporate are able to say, this is what sovereign, So we have to wait and see, of course, what happens. I'm throwing in the Mervyn King's thing. It's actually older than even Dr. Weiss. A more fundamental example of reform would be to divorce the payment system from lending activities. That is to prevent fractional reserve banking, for example, as proposed by Fisher in 36, Friedman in 60, Tobin in 87, and by more recently Kay in 2009. Of all the ways of organizing money and banking, the worst is the one we have today. You remember my talk, my little article, The Problem with Money and Banking. That was my opinion, but this is Mervyn King's, and it seems to me that we're saying the same thing. Okay, so naked capitalism. Well, I'm not allowed to comment here, but I still go there every day. And I'm going to admit why. It's a great website. It is a really great website. If you're a progressive, and I consider myself a progressive, these guys are progressives. They really are. The links that they put on to depict the state of the world in terms of news of money, finance, all that stuff is better than anybody's. And I go to a lot of websites. I go to a lot of people who post daily stuff on what's going on in the world. So all my credit goes to Eve Smith and those guys. If only they got money. I'm telling you right now, if only they got money, we would really be able to do something. But they get money. They don't get money in a big way because Warren Moser, makes sure that they don't get money. I don't know if you can read this, and let me read it from up here. This was an article that was printed just very recently by J.D. Alt. It's called "The Charade That Deters the Use of Direct Spending to Fund Federal Operations." The charade that prevents the government from using public money to fund it. What is that charade? Anybody know? Debt-free money. Debt-free money. Somehow or other, we're responsible because we put out the fact that you could do it, and that has become the obstacle to them being able to do it. So I said to myself, well, let's see what J.D. Alt says. So I read through the whole article, and then I read down into the comments. And it was in the comments that I actually got some encouragement. And I hope I'm going to be able to read this. Okay, great. Okay, so that's the article. One of the first earliest comments is by Eve Smith herself. Now, she doesn't always jump in on articles, okay? It must be important. So modern monetary theory is important. She says, I hate sounding mean-spirited, but the debt-free money construct is bunk. She has 20,000 or 25,000 loyal readers every day, and that's the message that they get for today. The debt-free money construct is bunk. I don't even want you to read some of that other stuff because it's so ridiculous that it goes it oughtn't to see the light of day. The worst, she says, about us is that we take some of the ideas from MMT. Okay? And we succeed in confusing people about MMT and use its growing legitimacy, MMT's growing legitimacy, to promote our intellectually incoherent program. Okay? And then she says, I have to second Skippy on Ellen Brown, which Stephen would love to hear, but I'm not going to bring it up, okay? She means well, but she doesn't understand the Fed or money at all, and her grip on banking operation regulation isn't that so hot either. So that was Eve Smith's comment in there, okay? But along comes Diphtherio, okay? Now, what I want to tell you about Diphtherio is way back in the day when I started commenting on naked capitalism, Diphtherio was there. And he has stayed. And he has been a loyal naked capitalism consort. But he comes in here and he says this. A few yeah buts here. Given that the debt-free money crowd has a large following, look around. I did laugh at that. I do think it's important that we make attempts at communicating in a respectful way what we think they're missing. Well, that's a great thing because that's what I wrote to Eve years ago and said, why aren't we talking about it? Okay. So it says, fortunately, they do share a number of concepts with MMT. I'd say that's the place to start. And if you read it, that's where it goes. Okay. Sorry, but then Skippy comes in. Now Skippy is loyal. Okay. I get your point, but sadly I must report from a perspective many years in the making that debt-free resorts are akin to libertarian gold bugs, and I don't say that as an emotive slur. It's something else, okay? But I want to get to the good part, okay? It says, Eves makes a fundamental point in the whole debate, attempting to return to a quasi-gold standard. Been hearing a lot about that here, right? Okay? A quasi-gold standard with essential authority controlling quantity of money is intellectually incoherent from both an operational and historical perspective, as well as the massive trade shock and its inevitable outcomes. You might as well attempt to stop people from having sex. Now that's what you guys are doing, okay? That's why we're here, okay? So I want to be the first of the debt-free money crowd to say, keep having sex, okay? It's all right to keep having sex. And I'm going to have to end it right there. Thank you.
Thanks so much, Joe. That's awesome. I'm sure there's lots of questions. Joe is probably the expert, well, one of the experts on MMT and engaging them. So if you've got any specific questions as to how they think what they think, then Joe might be able to answer those.
Sure. Any questions? Sue?
Joe, I just want to say, having spent a year and a half in Occupy Alternative Banking, in which Eve Smith, whatever her name, was there, and watching how every step of the way she kept the concept of talking about a monetary system out of that group, that I would not recommend anyone go to her site, because this is what happens. They plant people and they have them come on.
Yeah.
And then when it comes down, to watch people in that group for so long just listen to lies. And she presents herself as an expert, right? But I can't, when Stephen came to try to talk, the drama she put on in that room, I'm not saying, she became dramatic, stopped any discussion, and the head of the group, who is also part of the group, said, oh, well, everyone's so upset, we can't go on. Well, then Stephen didn't get a chance to talk. It was total drama, manipulation, and she's the queen of it. So I would not suggest people, especially people who don't know the history of the money system, to go to her site. It might look good, but it's like a spider pulling people in.
Yeah. Well, I think I'm sure that you're right about that as far as the monetary discussion goes. But on the other hand, if anybody wants to try to point me in the direction of a better site that has all the links to, whether it's Hillary's email or exactly how the TPP is being advanced, to our detriment, and they do a most thorough job of that. And so, yeah, I mean, I acknowledge that, but if you want to go there don't go there for money. Don't go there for money. Oh, sorry. I'm sorry. Somebody have a microphone.
Part I don't understand is the central bankers say that they don't know what's going on, but they're the ones in the system. It's confusing to me that they keep claiming that this is a travesty, but they're the ones that actually running. So why do they understand what they're doing? Or is it because they don't want to?
Okay, so yesterday John Howell gave in his talk, he talked about his banker friend, okay? And when the Kettle Pond Institute got started, which it got started after for 20 years, me and my Kettle Pond Men's Group, which is KPMG with small letters, okay, had our annual outing at Kettle Pond September 15th, 2008, when the crash happened. And all of a sudden, after 20 years of talking to and now everybody started with the Kettle Pond Institute. We're going to talk about debt-free money. We're going to go out and advocate for debt-free money. And then Pete laid it on me. He said, you know, my dad was the president for 15 years of a bank in Pennsylvania. Oh, really? I didn't know that. So he said, okay. Well, he said, what do you think my dad would say about what you're saying? I said, I have no idea. You know, I said, my dad says, you know, 90% of the bankers don't know how money is created, and I think that is the answer. And so Pete engaged his dad. He said, Dad, I met this guy, and he says, you know, banks just create money out of nothing. And Pete's dad said, that's not true, you know. So, and this is my suggestion to John, because I said, well, Pete, you should ask him what the accountants say about what their balance sheet looks like the day before and the next day, and the loans that were made, and what you would find is that they created the money out of nothing. In other words, they didn't lose anything. They don't take money out of their reserve account when they make loans. They just deposit it as a liability. So Pete, you know, said to his dad, well, how about that? And his dad said, no, you know, why are you listening to that guy? I won't say what else he said. But anyway, but then I said to Pete, but your cousin Patrick, doesn't he work at the Federal Reserve Bank of New York? He said, yeah. I said, well, then the question should go to him, you know. So he did. So Pete took it to Patrick. Patrick, do the banks create money when they lend? Yeah. Yeah. Well, tell Dad. So really, what I really wanted to say, and I did say this last year, and Stephen and I had a little dialogue about it. Central bankers are just as good at people as bankers are just as good at people as anybody in the world. Okay, there's no thing that afflicts central bankers with malady. So they all got involved in it for whatever reason. You know, of course, the prosperity, of course, living at the top of the heap. Yeah, but they're there to do a good job. They're there to try to make it work. Now they think, well, I'm advantaged because I'm here to make it work. But then when they come to find that, in fact, more debt is required in order to have more money, in order for us to keep this thing going, but the people don't want to borrow anymore, that's when they realize that the jig is up. And not until then, because until then, everything is going along just fine. So I believe that Dr. White is right, you know, both in his observation about how the bankers feel, and that they came by it unaware. I do believe that. They came by it unaware.
Coffee break?
Oh, sorry.